The local index and the rand will be hoping to end the week strong. The JSE was muted with major indices mixed yesterday, and investors are watching the latest batch of US jobs reports for insights on the Federal Reserve's rate path. Simon Brown of JustOneLap joins us now to look at how the markets are faring and what's moving them. Simon, good morning as always, and thank you for your time. Let's start with that overview of how the markets are faring this morning.
Well, Nima, we've had a strong start to the day, which is nice to see. The overall market is up almost a full percent higher, being led by industrials up just over 1%. Resources also a little under 1%. Financials are the laggers. They're only 0.5% higher. Rand is strong across the board, 18.59 against the dollar, 23.32 against sterling. And in the euro, we're below 20 at 19.93. for €1. On the commodity side, gold a little weaker, $2,308 an ounce. We've got Brent at 84.02, which is a little higher. PGM's mixed, platinum up at 9.66 and palladium weaker at $932 an ounce.
Let's go to oil, and it's set for its steepest weekly loss in 3 months, while gold is holding steady but on track for a second weekly fall. Talk us through those developments.
Yeah, so I think the oil story is quite interesting. The dynamic is that there's not huge demand for oil because there isn't a global economy that is absolutely rocking. We got some US GDP last week, 1.6% for the first quarter. It's growth, but it's a little bit slow perhaps, and certainly less than the market had hoped for. And I think the other development which we saw earlier in the week was the reserves that the US stockpiles. They'd been buying a fair bit, over 10 million barrels they've added to reserves, which essentially tells the market that some of that demand in the market for oil was not the demand for use, but rather for storage, which I think spooked the market a little bit as well. So we have seen some weakness, and hopefully it can last long enough to give us a June petrol price cut.
And the clock is ticking, Simon, to see whether the management of construction group Stefanuti Stocks can successfully stage a turnaround of the struggling operation as it paces through the 5th year of its restructuring plan. Are there any notable changes that you've noticed so far?
No, I mean, the big story here is they've actually got an extra year, so it now runs to the middle of, to June of next year. By then, we'll be in our 6th year of restructuring. Part of the trick with Stefanuti Stocks is they've got claims, arbitration claims on work that they've done, which they claim they've been underpaid, or the company providing it has said that the work wasn't properly done. One of these, of course, is Kasile, but those arbitrations are taking a long time. They've fixed up one. They've had some in Zambia. Those have been concluded, but generally the slow process of the arbitration is really delaying their restructuring plans because they need certainty on how those are going to play out.
Oh, so this next one is really one that many South Africans can relate to, Simon. South Africa's biggest 4 banks have about 98 billion rand of home loans that are in stage 3. And stage 3 is the last stage before a loan is deemed to be non-performing. And this really kind of reflects the effects of those high interest rates over a long period on consumers. Talk us through those numbers.
Yeah, Iman, you're 100% right. It is the consumer is struggling. It's not just the high inflation. Fortunately, load shedding has abated for the last couple of weeks or months or some change. But of course, the high rates at the same time. And typically what we see with the rate increases, particularly on home loans, is there's a fair lag, 12 to 18 months before it really starts to bite. And that's simply because the consumer is going to do everything in their power to not lose their home. They're going to skimp and cut back on other areas first. 100 billion, it's a giant number. Truthfully, in the big picture, there's about 2 trillion rand of home loan debt in South Africa, but it does show the pressure on the consumers, and this is going to start coming through in pressure on bank earnings as their bad debts, or payments as they call it, are kind of already top of their through-the-cycle range, and I think we'll start to see this year's results and into next actually going to start creeping higher than those upper targets. And the consumer, maybe we get rate cuts later this year. That's the expectation, but it's still going to take some time before that pain on the home loans really starts to alleviate.
Simon, thank you very much as always for helping us make sense of what's happening in the markets. We'll chat again next week.